Do not buy a single ounce of silver this month until you watch this video. I am serious. Silver is sitting at $82 right now. It was $121 12 days ago. That is a 32% destruction of value in less than 2 weeks. And right now, in the next 7 trading days, there are 3 specific catalysts that will determine whether silver recovers to triple digits or drops below 75. I am going to walk you through every single one of them, give you the exact dates, the exact levels, and exactly what to do in each scenario. This is not a guess. This is a forensic calendar of what is about to hit the silver market like a freight train. Before we get into it, I need to know, where are you watching this from right now? Are you sitting in your home office in Texas refreshing the spot price every 10 minutes? Are you on a lunch break in London wondering if you should have sold at 100? Are you watching this at 2 in the morning in Sydney because you cannot sleep after what happened last week? Drop your city and what time it is right now in the comments. I want to see how far the silver community reaches across the globe. And if you are new here, hit that subscribe button right now. This channel delivers daily silver intelligence, not hype, not hopium, forensic analysis of exactly what is happening in the gold and silver market and what it means for your money. Alright, let us get into the autopsy of what just happened, because you need to understand the crime scene before I can show you the 3 scenarios for the rest of February. Here is the timeline. On January 29th, silver hit an all-time record of $121.88. The momentum was parabolic. The Shanghai premium had spiked to $14 over London. SLV saw a record $171 million in inflows over 2 days. Retail investors were piling in. Social media was on fire. And then within hours, the CME group announced an 18% margin hike on silver futures. That was the bullet. On January 30th, silver crashed 26% in a single session from 121 to 84. That was the single largest one-day percentage decline in 45 years. They did it again. The same playbook from 1984. The same playbook from 2011. Raise margins, trigger forced liquidation, cascade stop losses, and let the algorithms do the rest. And here is what nobody is talking about. On that exact same day, January 30th, the Kevin Warsh nomination for Federal Reserve Chair was announced. That is not a coincidence. That is a coordinated information environment designed to maximize downside pressure on precious metals. Now, silver has been grinding between 75 and 85 for the past 11 days. And here is what I need you to understand. We are not in a recovery. We are not in a bear market. We are in a decision zone. The market is coiling, and the next 7 to 10 days will determine the direction for the rest of the first quarter. Let me show you why. There are 3 specific catalysts hitting the silver market between now and February 24th, and each one of them has the power to move silver 10% or more in either direction. Catalyst number 1, the January jobs report. This is dropping today, February 11th. It was supposed to come out on February 6th, but the partial government shutdown delayed it by 5 days. This is not just the January data. This report also includes the annual benchmark revisions to payroll data going all the way back to 2021. Federal Reserve Governor Christopher Waller already dissented at the January meeting and said publicly that once the revisions come in, 2025 job growth will show virtually zero. His words, zero, zip, nada. If those revisions confirm what Waller is saying, the market will immediately start pricing in faster rate cuts. And faster rate cuts mean a weaker dollar, and a weaker dollar means silver goes up. Hard. Catalyst number 2, the January CPI report, Consumer Price Index. This drops on February 13th. Also delayed by the shutdown. Inflation data is the single most important variable for the Federal Reserve right now. They held rates steady at 3.5 to 3.75% at the January meeting. The market is currently pricing in about 60 basis points of cuts by year end. If CPI comes in hot, that gets repriced. If CPI comes in cool, silver gets a tailwind. Pay very close attention to core CPI. That is the number that moves metals. Catalyst number 3, and this is the one almost nobody is talking about. The Shanghai Futures Exchange and the Shanghai Gold Exchange are both closed from February 13th through February 23rd for Chinese New Year. That is 9 full trading days where the world's largest physical silver buyer is completely offline. No price discovery from Shanghai, no physical demand from Chinese industrial buyers, no premium signals from the East. For 9 days, Western paper traders have the silver market entirely to themselves with no Eastern physical floor underneath the price. Every single time Shanghai closes for an extended holiday, Western institutions use that window to press prices lower. They know there is no physical bid to absorb selling pressure. This is not conspiracy. This is documented seasonal behavior. And this year, it is happening while silver is already 32% off its highs and sitting right on critical technical support. Now, here is where this gets actionable. I have mapped out 3 scenarios for what happens between now and February 24th, when Shanghai reopens. I am giving each one a name, a probability, and an exact price range so you know precisely what to look for. Scenario 1. I am calling this the trapdoor. Probability, 35%. In this scenario, the jobs report comes in weak, the revisions confirm Waller's zero growth thesis, but CPI comes in hotter than expected. The market gets confused, conflicting signals, and during the Shanghai closure window, Western institutions use the confusion to push silver below the $77 support level. If 77 breaks, the next major support is 74, and below that, the February 6th low of 75. In this scenario, silver trades between 72 and 77 for the rest of the month. This is the bear trap. It looks like the bull market is over. It is not. It is a liquidity vacuum created by the absence of Eastern physical demand. The action plan, if this happens, this is the accumulation zone. If you have been waiting to add physical silver, this is your window. Physical premiums will stay elevated even as paper prices drop. The disconnect between paper and physical will be screaming at you that the real market knows something the futures market does not. Scenario 2. I am calling this the grind. Probability, 40%. This is the most likely outcome. The jobs report comes in roughly in line with the 80,000 consensus. CPI is neutral. No major surprises. Silver continues to consolidate between $78 and $86 through the rest of February. Low volume, tight range, boring price action. This is what the algorithms want. They want you to get bored and sell. They want you to look at your portfolio, see that you are still down from 121, and decide the bull market is over. The action plan here, do nothing dramatic. This is a coiling pattern. The longer it coils, the more explosive the eventual breakout. Historically, when silver consolidates for 3 to 4 weeks after a major crash, the next move is almost always in the direction of the prior trend, which was up. Use this time to study your cost basis, review your physical versus paper allocation, and prepare a plan for March. Scenario 3. I am calling this the slingshot. Probability, 25%. In this scenario, the jobs report comes in dramatically weak. The benchmark revisions / hundreds of thousands of jobs from 2025, CPI comes in soft. The market starts pricing in 3 or more rate cuts by December. The dollar index, which is already below 99, drops further, and silver does not wait for Shanghai to reopen. It rips through 86, reclaims 90, and starts approaching the psychologically critical $100 level before March. The catalyst accelerant in this scenario is Bank of America's Michael Widmer, who just last week maintained his $135 to $309 silver price target for 2026 based on gold to silver ratio compression. If silver starts moving toward 90 while these institutional targets are public, momentum traders and algorithms pile in and the move feeds on itself. The action plan here. If silver breaks and holds above 86 on a daily closing basis, the consolidation is over. That is your signal. Now here is the part that ties all 3 scenarios together, and I want you to really hear this. Regardless of which scenario plays out over the next 2 weeks, the structural fundamentals have not changed, not 1 ounce. COMEX registered inventory is still at approximately 108 million ounces. That is a 50-year low. The paper-to-physical ratio is still approximately 378 claims for every single deliverable ounce. China's export controls that went into effect January 1st are still in place. Only 44 licensed exporters in the entire country. The global silver market is in its 5th consecutive year of structural deficit, projected at 200 million ounces for 2026. Gold is holding above $5,000. The gold to silver ratio at 62-1 is still historically elevated, meaning silver has massive room to outperform. If the ratio compresses even modestly toward the long-term average of 50-1, the crash from 121 to 82 did not change any of these numbers. It changed the price, it did not change the fundamentals, and in every single previous cycle, 1980, 2011, 2020, when the price corrected but the supply deficit remained, the subsequent rally exceeded the previous high every single time. If this forensic breakdown is opening your eyes to what is really happening in the silver market, smash that like button right now. It helps this video reach more people who need to see it. Let me be honest with you for a second. I want to know where your head is at after the last 2 weeks. Type I sold in the comments if you liquidated during the crash. Type I held if you did not sell a single ounce. Type on the dip if you actually added at these levels. No shame, only data. I want to see the real breakdown of what this community did during the most volatile silver event in 45 years. Now let me give you the specific dates to circle on your calendar for the rest of February. February 11th, today, the delayed January jobs report plus benchmark revisions. February 13th, the delayed January CPI report. February 13th through 23rd, Shanghai exchange closure for Chinese New Year. This is the danger window for paper price suppression. February 18th, FOMC meeting minutes from the January 28th to 29th meeting are released. These minutes will reveal the internal debate about rate cuts, about Waller's dissent, and potentially about the impact of precious metals volatility on financial stability. February 24th, Shanghai reopens. Watch the Shanghai premium immediately. If it spikes above $10 over London on the first day of trading, that tells you Eastern physical demand was building behind the dam the entire time Shanghai was closed, and when that dam breaks, price moves fast. Here is the bottom line. February is not the month to be a hero. It is the month to be a forensic analyst. Watch the data. Watch the dates. Watch the levels. 77 is your downside line in the sand. 86 is your upside confirmation. Between those two numbers, patience is the strategy. And remember this, while you are watching the paper price bounce between 77 and 86, somewhere in Shanghai, somewhere in Mumbai, somewhere in a central bank vault in Asia, physical metal is being accumulated at prices that the people doing the accumulating believe are dramatically below fair value. The question is not whether silver is going higher. The 5th consecutive year of supply deficit answers that question. The question is whether you will be positioned correctly when the next leg begins. What is your February strategy? Are you buying at 82 or are you waiting for 75? Comment your number below. I want to see the range of conviction in this community. Share this video with one other silver holder who needs to see these 3 scenarios before they make a move this month. And subscribe if you want daily silver intelligence that the mainstream financial media is not going to give you. The next video is going to break down exactly who was buying silver while you were selling during the January 30th crash. Follow the money. The delivery data tells a story that will change how you see every pullback from this point forward. I will see you in that one. This is not financial advice. I am not a financial advisor. This is news analysis and market reporting for educational purposes. Always do your own research and consult a licensed professional before making any investment decisions.